It was another bad week on inflation. We had numbers we hadn't seen in 30 years now. For the month of May, year over year, it was 5% up in the top line number. What do you make of it?
Look, it's more evidence that we've got a problem, that the risk to the economy is overheating, that you can't have COVID get to the rearview mirror, fiscal policy be pushed to the floor in terms of the accelerator, monetary policy be pushed to the floor, the consumer coming roaring back, and have it all fit together. You just can't. And it's going to lead to problems. And the sooner we recognize that, the better it'll be. You know, David, here's something I think people don't appreciate that maybe is worth highlighting for your listeners. Monetary policy isn't constant. Monetary policy is getting easier. When the interest rate stays the same and inflation rises, real interest rates fall. So monetary policy has been getting steadily easier through this year, even as the economy's booming. And if you do what the analysts at most of the banks do, and it's a sensible enough thing to do, form a comprehensive index of financial conditions where you look at the stock market and you look at the dollar and you look at long-term bond yields and whatnot, then the rate at which it's getting easier and the extent to which it's unprecedentedly easier is faster.
Okay, so Larry, just to reinforce your point, negative real yields are down lower than they've been since 1980 when inflation was out of control. But let me play the red team here a little bit and make the argument it's transient. That's what we keep hearing. And it really has to do with the parts of the economy that are reopening. Look,
David, we have transient inflation. Annual inflation in last month, according to core CPI, was above 10%. Majority of that is surely transient. We've got used car prices. We've got other examples that people cite that are clearly transient. But it is an elementary fallacy to confuse the idea that we have some transient inflation with the false proposition that all the inflation is transient and we have nothing to be concerned about. If you look at things that are longer lasting, labor shortages, pervasive. If you look at things like the largest component of the cost of living index, housing is on fire. As you know, as your listeners know, the majority of houses are selling above their asking prices. In many parts of the country, housing inflation has been close to 20%, the vast majority of which has not yet shown up in any index. And so if you look at what purchasing managers are saying, if you look at what households are expecting, all of this suggests that we're in the process of seeing a change. And the people who are big on this transient idea need to ask themselves, do they really believe that 10% growth, which we're going to have this quarter, 10% growth, which people think we're going to have next quarter, dramatic declines in unemployment or growth in labor shortage, either way, that we're going to have all that and that's going to be part of a process that drives inflation down? I don't think so.
Assuming you're right, which I do, why aren't the markets reacting? I mean, you can sort of expect the inflation, but I think we would have expected the markets to react.
So, unlike many of the others in this debate, I admit it when I'm surprised and what happened is not what I expected, and I think about how I have to change my thinking. And just as they didn't anticipate what happened to the inflation figures, I didn't anticipate the kind of decline in nominal yields that we've seen. So I've spent a lot of time thinking about it.
Finally, let's have a quick summer says here if we can, Larry. Let's do it a little bit differently. You've been a professor for many years, tenured professor. Give some letter grades about how some institutions have dealt with this pandemic. Start with the IMF.
A-, maybe an A. They've recognized the gravity of the problem. They organized the raising of SDRs. They called for dramatic responses. The reason I say A- is they've been a bit more aggressive about telling everybody else to spend their money than they have about putting their own balance sheet on the table. But I think Kristalina Georgieva has done a great job, and I wish all our international institutions were as effective as the IMF.
What about the World Bank?
Incomplete at best. The World Bank's leadership has been committed to a model that sees the bank as a kind of business institution that focuses on individual country lending, that focuses on debt restructuring. The World Bank needs to be about world public goods.
Last one, the United States Senate. How has it handled the pandemic?
The fact that there is bipartisan legislation on competitiveness is something that's encouraging, although I sure wish it was more about research and less about bailing out particular U.S. industries. I'm pretty disappointed that it doesn't look like we're going to manage to do what it seems to me we obviously need to do, which is to tax affluent people more to finance a significant increase in public investment. And I'm especially worried that the only bipartisan deals on the table leave out what's probably the most important historically part of Joe Biden's $4 trillion program, which is the emphasis on green.
Larry, you mentioned the president. I want to let you go with that. You're commenting on a report that's come out. Since you and I have talked on this program before about you're talking with President Biden, you've sometimes said some things on this program that he might not have liked. What kind of reception are you getting from the White House these days?
You know, David, I have a absolute policy, even for my best friends in journalism, like you, that I don't talk about conversations I have with senior government officials. I think it's the right policy out of respect for them, and frankly, for me, I think that I'm likely to be able to have more conversations with senior government officials if I have a policy of not talking about them.